Welcome everyone to the 2020 Media Super Annual Members Meeting. My name is Shauna Black and I will host this meeting. I'm a Trustee Director of Media Super, the Chair of its Investment Committee. I have a 35-year career in print journalism and now have my own business called Black Stump Media, which I operate from Kangaroo Island in South Australia. I'd like to begin by acknowledging that I am hosting this meeting from the lands of the Ngarrindjeri people. I also acknowledge the traditional custodians of the various lands on which you all gather today and the Aboriginal and Torres Strait Islander people participating in this meeting. I pay my respects to elders past, present and emerging and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and water. We have with us this evening a quorum of directors of Media Super, that is 8. Those directors are Susan Heaney, Gerard Noonan, Katrina Ford, Dale Bridle, Carmel Tebbit, Jim Reid, Peter Clark and myself. We have apologies from Gary Callahan, Matthew Diener and Andrew McCauley. Also present are all senior executives and the external auditor David Salmon from Deloitte. Welcome to everyone joining us from across Australia in all your various time zones and the world indeed to our members meeting run exclusively online this year. Tonight's meeting will be recorded and a reminder that any information presented tonight is of a general nature only and does not take into consideration your personal objectives, situations or needs. Find out more information by reading our product disclosure statement available at mediasuper.com.au/PDS. With regard to investment returns, they are not guaranteed and past performance gives no indication of future returns. Also, a reminder that tonight is a members meeting. It is not a public meeting and it is not appropriate to make media reports about this meeting. Tonight, you are going to hear from Media Super's former chair, Gerard Noonan, who was chair for the financial year to 30th of June 2020, followed by Media Super's current chair, Susan Heaney. Then CEO, Tony Griffin, will give a fund overview. Finally, our Chief Investment Officer, Michael McQueen, will detail how Media Super has travelled in the financial year to 30th of June 2020. At the conclusion of Michael's presentation, we will move into the question and answer section of the event. I'd like to also acknowledge the other directors of Media Super who are on this webinar and whose photos are on screen now. While I'm sure many of you have been exposed to Zoom or something similar, I will quickly point out some of the options available to you today as you participate in this live meeting. If you'd like to ask a question about Media Super or of the board or executive, you can do so at any time using the Q&A button at the bottom of your screen mostly. It is in the middle of the bottom of your viewer if you're on a desk or laptop. We encourage you to ask questions throughout the presentations. However, we will only be responding to the questions at the conclusion of the prepared speeches. Any questions that relate to your account or specifically to your circumstances cannot be answered in this format. We do have a good amount of time for questions at the end. However, should we run out of time tonight or it is not reasonably practicable to answer your question, we will have a response to your questions available on the website in the next few weeks. A reminder, we cannot answer any personal or account sensitive questions within this forum, although a member of our team can be in touch to assist you following tonight's meeting. Also, in the next few weeks, you will find a recording and minutes of tonight's events on our website. Let's begin tonight hearing from Gerard Noonan. Gerard was the chair of Media Super from 2008 until September this year, 2020.
Thank you, Shauna. Thank you, Shauna, from Kangaroo Island. And hello, everyone, and welcome from Sydney to this, our second annual members meeting at Media Super. So last year, around this time in November, we held our very first annual members meeting. And this year, with the COVID-19 pandemic, we're conducting this meeting entirely online. There are approximately 200 members attending. That's about 3 times the number that attended last year. Shortly, I'll introduce our Chief Executive Officer, Tony Griffin, to walk us all through the fund highlights of the past year. But just for a moment, I'd like to take a little of your time to reflect on some longer term trends in superannuation and media supers, and thus your role in benefiting from the great innovation which is the Australian superannuation system. I've been chair of Media Super, as Shauna mentioned, for 12 years. Before that, I was chair of Just Super, which was a super fund for the actors, musicians, journalists, and performers in this country. At my very first meeting of Just as chair in the midst of a recession in the early 1990s, I recall there was $6 million in the fund, $6 million. It seemed to me then an incredible amount. Imagine letting journos, of which I was one as the editor of the Australian Financial Review, as well as actors and musicians, loose with $6 million. But roll the clock forward to today. Media Super, which is the result of a merger 12 years ago between Just Super and Print Super, which covers workers in the printing, graphics, and manufacturing industries, has 6 billion, yes, billion, of your money to manage for your retirement. The great industry fund movement, of which Media Super is a key part, represents, in my view, one of the great financial innovations in this country in the past century. Now, on a few occasions when I've been at pension fund or superannuation conferences offshore, I've been struck at how quickly the delegates from other countries want me to explain exactly how we did it. So I've told them two things. Firstly, it started with one really good idea. The idea was sponsored by unions and backed by a sympathetic and very far-sighted Labor government and a scattering of very thoughtful employers. Put aside a small amount of your income each week, it started at 3%, and give it time to grow. Resist the temptation to spend that amount now, but rather enjoy the benefit later in life, assisted by that great multiplier of compound interest. And who should look after this money to be kept in trust for decades? So the industry funds were established. You know, those funds. Just Super and Print Super and others like Hester and Host Plus and CBUS and Australian Super, with governing trustee boards with equal numbers of willing employer representatives and enthusiastic union representatives. Secondly, I say, its creation didn't happen without a fight. I remember, because I was one of those young journalists, that may seem unlikely, but we were all young once, who campaigned and went on strike and were locked out in our efforts to win the benefit for fellow journalists and actors and musicians. Eventually, it became law, and the amount now is 9.5% of wages going to super. It should, of course, be 12%, but a group of reactionary politicians who happen to be in power at the moment are trying to prevent it going to that figure. It was the same group of politicians and some in business who opposed the creation of Australia's super system all those years ago. I know. I was a young reporter working for the Financial Review and wrote story after story about their attempts to thwart the system taking root. And you know what really gets under the skin of those people? For the past 3 decades, decisions taken by industry super funds under the equal representation model of governance have been superior to those other funds run by people who are supposed to be professional financial players. And the evidence is there. The outperformance over 3 decades is there, year after year after year. Industry funds, including, of course, Media Super, have taken investment decisions for the long-term benefit of members, which have seen our funds outperform the retail funds, typically owned by the 4 or 5 major banks, by up to 2% each and every year for 30 years. Now, that's a heap of money. Early on, we decided we shouldn't just invest in the stock market. Members wouldn't access their super for around 30 years, so why such a short-term strategy? Instead, we invested for the long term. Thus, we tapped into the premium that attached to long-term assets like property, infrastructure, private equity, and in a few cases, into venture capital. The retail funds had virtually no exposure to these investables. That's why you, if you're in our most popular balanced fund, each own a part of airports around Australia, railway stations, electricity grids, pipelines, and commercial and retail centres. You have a stake in a major toll road in the United States, and you even own, with your fellow industry fund members, the London water supply and Manchester airport. I can tell you, Londoners aren't at all impressed that paying their water bills is helping improve the super accounts of we colonials. Over 20 years, that outperformance has gone straight to the bottom line of our members' accounts. That's the whole point of super. So while I'm still compos mentis, I'll defend this great innovation against constant and sometimes malevolent detractors. It's not my system, it's your system, and it's definitely worth the effort. And speaking of innovation, we at Media Super have been able to find valuable investments which have had the side benefit of supporting our own industries. One notable one has been our successful underwriting of almost 200 Australian film and television productions. We've been able to make very healthy returns for all of our members while simultaneously helping to support the local film industry. Films like Last Cab to Darwin, Lion, Ride Like a Girl, as well as TV series like Rake and Clever Man, and it's backed by a federal government guarantee. In similar vein, we've invested for the long term in several 400-year-old and very valuable classical instruments, which are played by members of the world-renowned Australian Chamber Orchestra, directed by Richard Tognetti. So, where are we at present? You may have seen some media recently about our board's decision to consider whether we can prosper as a fund in the immediate future, or whether we need to partner with another industry fund to gain the benefits of greater size, especially with investments. It's on our website. The scale of the regulatory, compliance, and information technology frameworks that a fund needs to have in place makes it akin to running a social security system. So to be able to do all of those things and remain a smaller fund is a pretty tough challenge. Thus, we're in the midst of discussions with a fellow industry fund, CBUS, to explore whether our members can benefit from a closer working relationship with that fund. We have almost completed a process called due diligence. I think the journalist in me would prefer to use the term kicking the tires, so that both funds can assess whether it's in the best interests of our mutual members. If it goes ahead, our smaller fund will be part of a $60 billion enterprise. So that's an impressive move from $6 million in funds in the early 1990s to $6 billion at Media Super today to $60 billion by combining with CBUS. Industry funds like Media Super and CBUS and Australian Super have provided great returns to millions of Australian workers, money they simply would not have had if the system wasn't put in place. We're lean, we think we're low cost, and have earned our members on average more than 7% every single year over the past 3 decades. I say to people, beat that if you can. Now, before I introduce our new chair, Susan Heaney, I'd like to take a moment to thank someone who has given great service to your fund. This time last year, our CEO, Graham Russell, was in hospital, very ill with cancer. He has survived the ordeal, thankfully, and has recovered well. Graham made a decision to stand down as CEO earlier this year, and his place has been taken by the very able Tony Griffin, who will speak to you shortly. Thank you, Graham, for your long association with Just and Media Super and the wider world of industry funds for so long. And now to introduce Susan Heaney, our new chair. While I come from the union side of the equation, the Media, Entertainment and Arts Alliance, Susan is a nominee of the employer organisation, the Print and Visual Communications Association. Susan runs a successful printing business on the Gold Coast in Queensland and is a former national president of the employer group PVCA. She has been our lively and highly valued chair of the fund's Audit and Risk Committee for some years and has been a great supporter of industry funds, their governance structures, and, like me, is very proud of our achievements and our superior investment performance. Susan Heaney.
Excellent. Good evening, fellow board members and members who've joined us from across the country tonight. And thank you, Jared, for that introduction, both myself and also for your valuable time over the past few months, as you have given time to mentor me so I can take the mantle as chair of this wonderful fund, Media Super. I have learned a lot of lessons from Gerard. Public speaking is yet to be mastered as much as he, but bear with me and I shall go on to my speech. I believe in diversity, and I think that is what has helped the industry super landscape. And as an employer-nominated director, I'm of the belief that this diversity in the backgrounds and knowledge of our trustee directors has been a linchpin in the success of the industry superannuation model. That, and of course, a passion to better the retirement outcomes of all Australians. I too am a long-standing champion of the industry superannuation schemes and the beliefs that it espouses. I was introduced to superannuation back into the 90s. I was asked back then to join the fund of an industry super fund, Hort Super, which I did for 5 to 6 years. I went on with that fund until they merged with Prime, another industry fund. A couple of years passed, and then I was approached by the then Prince Super to become an alternative director. And obviously that happened, and the story continues to the point where now I've joined the Media Super Board. My journey in both business and in superannuation has been one of constant learning, self-assessment, and engagement with stakeholders, re-evaluation and reinvention. These attributes are shared fully across the Media Super executive and the board, so we can continue to provide outcomes that offer continual improvement, longevity, and successful outcomes for all our members. Like all journeys in life, there's often a bump in the road, and were quite a number of those in the last financial year. Depending on the state you were domiciled in, you were either faced with drought, flood, or bushfires, or in some cases, all three. Everyone got to December and breathed a sigh of relief. And you can think that we were lucky the worst was behind us. But then, of course, COVID came calling. But life is an uncertain journey. And the best we can do is have a long-term and sound strategy in place that is monitored with good governance and risk assessment processes. And it was these processes at Media Super that resulted in returns to our balanced My Super option being above median during our last financial year, something that we're all proud of. Not only have we had changes in our economic landscape, but we've also had changes operationally at Media Super. Gerard has thanked our previous CEO, Graham Russell, for his long service and dedication and wished him well with his future. But I too would like to add our thanks to those of Gerard's. Which brings me to Gerard. Gerard has welcomed me, he has mentored me, but he has now stepped down as chair. But he is still with us as a member of the board, and he will continue to serve you, the members, in that role. Lastly, through the last financial year, we also had 3 long-standing directors step down so we could make way for board renewal. I would like to thank Philip Anderson, Peter Holters, and Stuart Gordon for their dedicated service over many years for the fund and its members. At this point, I'd like to thank you for your time, and I'd like to hand back to Shauna Black, who has the pleasure of introducing our new CEO, Tony Griffin. Thank you.
Thank you, Susan. Next up is Tony Griffin. Tony joined Media Super as Chief Operating Officer in 2019 before stepping into the CEO role earlier this year, replacing Graham Russell. Over to you, Tony.
Thank you, Shauna, and thank you to everyone for joining our 2020 annual member meeting. I would also like to acknowledge the traditional owners of the land that I'm presenting from this evening, and that is the land of the Eora Nation. I'd like to welcome our members, employers, partners, staff, and the board who all join us this evening. Thank you for working with us as we bring you this event exclusively via a virtual platform. When we started working on this annual member meeting, we had a clear goal, and that was to deliver a focused and professional event that encourages our members to engage. But that wasn't clear But what wasn't clear was the state the world would be in tonight, because the challenges of 2020 have meant that we need to look at the world quite differently. As we meet, the United States has a new president-elect, and while the sitting president is still in the seat until 20 January next year, we're all hopeful that this transition will proceed relatively in an orderly manner. Australia seems to be staying on top of COVID-19 after months of restrictions and lockdowns across the country. And when we started planning for this meeting, the business had decided to look for a like-minded merger partner, but more on the proposed merger a bit later. Whilst 2020 had presented us with a lot of uncertainties, there is one thing you, our members, employers and partners can be certain of, and that is everyone at Media Super works hard to ensure our members have the resources to work toward a comfortable retirement. This is what drives everything we do. No matter what we are faced with, this commitment does not change. And it's referred to in our industry as the best interest duty. This is a legal requirement of our trustees and of our staff. The beginning of the financial year seems like an eternity, but a lot has transpired during that time. Bushfires were ravaging much of the country early in the year, and indeed in New South Wales, we battled through terrible air quality. And wearing masks was not an uncommon concept. Little did we know that masks would be a new normal for entirely different reasons, only just weeks later. Since the bushfires were raging in different parts of the country, Media Super has received over 160 financial hardship claims from members, and this resulted in payments over $1.9 million. We've supported our members through a lot of change over the past 30 years. We understand the challenges you and your industries are currently facing, and we're working hard to support you through this situation wherever we possibly can. We know our members have done it tough this year. Our core industries of print, media, entertainment, and the arts have been severely affected by the pandemic. Freelancers, agency workers, and contractors who serve the community through their craft were not recognised in the various government relief packages. Many of our members have fallen through the cracks, and we recognise how difficult this has been. The federal government's introduction of early access to super meant that over 8,200 of our members were able to access much needed funds as the pandemic escalated. In the first tranche to 30th of June, members withdrew an average of about $8,600 from their accounts. That's from each account. The current second tranche is scheduled to cease on 31 December 2020. We encourage anyone thinking about accessing their super early to consider all options, as withdrawing your super early could have a big impact on your retirement savings. There's certainly been a lot of change to super in 2020. The federal government introduced significant changes to the way your super works. The legislation will affect some members' insurance arrangements. These new reforms, known as putting members' interests first and protecting your super, are designed to ensure members' insurance premiums do not unnecessarily erode superannuation balances. Under putting members' interests first, new members will not automatically receive insurance if they are aged under 25 or their super balance is under $6,000. The fund wrote to existing members who were affected by this change, and these members were given the opportunity to elect to retain their insurance. I'd like to thank those members who got in touch with us and decided to review their circumstances and retain their insurance. Protecting your super also impacts insurance through super. From the 1st of July 2019, insurance cover is no longer provided to members with inactive accounts. Inactive refers to an account that, regardless of balance, hasn't received a contribution for a continuous period of 16 months. We regularly contact affected members to warn them that they will lose their insurance cover if their account reaches 16 months without a contribution, and offer them the opportunity to keep their insurance. We encourage our members to review their insurance, particularly as their circumstances change. Other changes that were included in this legislation include superannuation accounts with balances under $6,000 that are inactive. That is, they have not any contributions, rollovers, or any other transactions for 16 consecutive months will be closed. Those funds are the Australian Taxation Office and allow it to consolidate with a member's active account. So the tax office search for accounts in other industry funds or other retail funds and locate those members' balances and consolidate those values. There's also now an annual cap of 3% on the account balance on investment and administration fees for all accounts with balances less than $6,000. And exit fees, they are now banned, meaning super funds can no longer charge a member a fee for moving your money to a different fund. In regard to investment returns, you'll hear from Michael McQueen, our Chief Investment Officer, who will run through our investment performance in more detail. But as the leader of Media Super, I'm delighted that our balanced MySuper option returned above median returns for the last financial year. The return for the financial year ended 30 June 2020 was negative 0.28%. We are in a comparatively better position than many funds, being above the median return of negative 0.82%. But the good news is that superannuation is a long-term investment, and we encourage you to look at our returns over a 3, 5 and 10-year time horizon. Media Super's long-term returns are still solid and meet their investment objectives. Our balanced options return for 3, 5, 7 and 10 years are all above median. Times of change and uncertainty can have us all questioning whether we are doing the right thing, whether that's the right thing for our family, health and financial goals. If among this backdrop, you have been thinking about switching your investment options, I do encourage you to reach out to one of our financial planners to discuss the best options for your personal circumstances, or contact our helpline for any account questions. Just check our website for these details. And as Shauna recently mentioned, we're unable to answer specific questions about your account in the forum this evening, but we encourage you to get in touch, and the ways to do that will be on the screen a little later. As I mentioned earlier, attending to the best interests of our members' retirement drives everything we do. I am proud to say that this financial year, the percentage of members who are on track to retire in comfort has increased from the financial year prior. Our predictive analytics show that 62% of you are on track or the cusp for a comfortable retirement, according to the ASFA retirement standards. If you're age 65 or over, that means an annual income generated from our allocated pension product of almost $62,000 for a couple per annum and $43,600 for a single person. This is compared to the current maximum age pension, which is $37,014 per annum for a couple and $24,554 per annum for a single person. At the end of the financial year, your super savings were a part of a larger pool of $5.9 billion, and we are cash flow positive. However, I must say that post 30 June 2020, the economic impacts of COVID-19 have meant the fund has moved to a cash flow negative position due to the government's early release program and a reduction in contributions due to the various government support programs that have been provided to employers. Independent research house Super Ratings awarded our MySuper and our pension products a platinum rating. According to Super Ratings, our fees are highly competitive and we're considered a best value for money fund with a fixed administration fee at $65 per member per annum and a 15 basis point variable fee based upon account balance, and our fees are capped at $600 per annum. We're proud to say that our pension product was awarded a 5-star CanStar rating. Once again, our pension and super products were awarded a AAA rating by independent research house Selecting Super, and our superannuation product also maintained its 5-star rating by the Heron Partnership. And these are fantastic results for a fund the size of Media Super. We've also given our website a fresh new look. It's now easier than ever to find information, resources and advice you need to grow your super. And this is all in order to make informed decisions about your superannuation account and the journey to retirement. If you haven't explored the website, I encourage you to do so. 2020 was a difficult year in financial markets, and Media Super, like many super funds, sustained investment losses due to the impact of COVID. Despite the challenging economic times, inflows from contributions and members electing to transfer their super in from other funds were over $418 million. That was up 3% on the prior year. The executive teams worked hard on members' behalf to contain investment expenses and other operating costs during the 2020 financial year, which were 12% less than the previous financial year. Since financial year end, investment markets have generally performed better and therefore adding value back into members' accounts. Aussies are a talented bunch, and now more than ever, Media Super is committed to supporting our industries to create new opportunities and help maintain vibrant, robust industries. While many film and TV productions had to shut down earlier this year due to COVID, our investment in the industry continued with funding ready for productions when they restart. To 30 June 2020, our unique investment, Fulcrum Media Finance, has loaned more than $235 million to support over 180 local productions. In turn, this investment's earned our members a healthy average return of over 6% per annum since inception. Especially in these times, it's important to recognise and celebrate excellence, even if it's virtually. And we have continued to support awards across the print, media, entertainment and arts industries, including the Equity Ensemble Awards, the State Printing Industry Craftsmanship Awards, the National Print Awards and the Walkleys. In financial year 2020, we continue our proud tradition of supporting a number of scholarships and internships to help build the future of our industries. These programs recognise and reward exceptional young professionals who show exemplary promise in their chosen field. This is just one of the ways we give back to our industries and support our future leaders. The financial year has also seen some fresh faces join the Media Super team. Elise van der Heide was appointed to the Chief Operating Officer position. Tara Collins joined us to head up the engagement team as General Manager of Engagement. And Media Super welcomed a new Chief Investment Officer, Michael McQueen, who you're about to hear from very shortly. These key appointments have strengthened our executive team, and I'm proud to be leading them through what is a very challenging and exciting time in terms of the continued development of industry funds. I would also like to thank the board for their dedication as Media Super moves toward an exciting future and the next phase of its journey. We always have you, our members, at the heart of everything we do. And speaking of our future, we are considering potential joint arrangement opportunities. You may have heard that Media Super and CBUS signed a memorandum of understanding and has entered a comprehensive due diligence phase. And while this took place in the current financial year, and this annual member meeting is centred around the last financial year, I will be transparent with you about the future of Media Super. The intention of the proposed operating model with CBUS is that each partner retains their own brand and identity while accessing the benefits of scale. The benefit of accessing greater size and scale includes wider access to investment opportunities, making it easier to maintain members' strong net returns, greater opportunities to reduce investment fees, innovative products, and a broader network of services and operations. CBUS is a like-minded, top-performing industry fund. They have over 54 billion in funds under management and over 770,000 members. Like us, CBUS is an intrinsic part of their industry and local community and dedicated to delivering better retirement outcomes for their members. The process of due diligence has been underway for some time now, and it's a very detailed process to determine if this arrangement will be in the best interest of our members. I'll provide more information about this as it becomes available. I would like to remind and assure you that Media Super acts in our members' best interest, and any decisions that we make will definitely reflect that ethos. So to finish off, 2020, what a year it's been. And as we enter December, I wish you all an enjoyable festive season and thank you once again for your membership and support during this year.
Thank you, Tony. I think that was a very good summary of the year and where we're heading into the future. A reminder to everyone online tonight to continue to ask your questions using the Q&A function at the bottom of your screen, and we'll get to those after we hear from our next speaker. I'd like to introduce Michael McQueen to you. Michael is our Chief Investment Officer. and he will now take you through Media Super's results and returns for the previous financial year that ended in June. Thanks, Michael.
Thank you, Shauna. 12 months, 30 June, was an extraordinary period for financial markets and the world itself. We saw growth assets like shares rally strongly in the first 6 months after concerns over Trump's trade wars abated. As the pandemic developed, financial markets fell suddenly and violently during February and March because investors were unable to price liquid assets like shares and credits. This was for 2 reasons. 1, an abundance of uncertainty around future cash flows from those assets, and 2, a lack of historic precedents. The modern financial system has simply never faced a global pandemic before. So central banks had to step in and pump liquidity into markets and provide emergency currency swaps. This was all to avert a seizure in the global banking and payment system. Thankfully, their efforts were successful. After falls of nearly 40% in some share markets in the space of just a few weeks, investors waded back in to buy, given cheap valuations on offer. Like many other super funds, we were active in March, buying assets at prices we simply hadn't seen in years. Markets then rebounded into 30 June as COVID-19 mortality rates remained low and lockdowns appeared to be a temporary measure. Our Balanced My Super option, which most of you are invested in, delivered a return of negative 0.28% for the 12 months to 30 June, putting it in the top 20 funds in the country. We're also proud of our performance over the medium and long term, which is all above median over all time periods. You can see on the next slide an example of the wealth we've generated for you over the last 10 years, and this is based on one of those compare the pair style of calculators. Looking at a metric that I like, return per unit of risk, this is a great way to see how efficiently your options are performing. I'm proud to report that our Balanced My Super option, our high growth, and stable options rank in the top 10 over 3, 5, and 7 years on this basis. Now turning back to raw performance, other investment options, our stable option was ranked in the top 10 over 3, 5, and 7 years, and our cash option was ranked in the top 8 in the last 12 months. Looking at the performance of our pension options, both our balanced allocated pension and growth allocated pension options were in the top 10 over the last 3 and 5 years. The stable allocated pension option was a top 5 performer over the last 3 years and a top 10 performer over 5 years and 7 years. I'd like to take a moment to thank the former Chief Investment Officer, Norman Zhang, for all his hard work. Norman was involved with the fund for nearly 8 years and was instrumental in achieving the long-term performance I've just discussed. Thank you, Norman. So having discussed returns for the financial year, let's touch on what we did. During the first 6 months of the financial year, we adopted a risk-on posture. This means our balanced option was running above its strategic growth allocation. Now we strive to construct all-weather portfolios in our premixed options. This means that we diversify across different asset classes and risk factors, so these options deliver strong relative returns through different market cycles. So when the pandemic struck, we stuck to our process. We convened numerous meetings of our Market Disruption Subcommittee in February and March to discuss developments and consider our next steps. These meetings resulted in the balanced option realising over $26 million in profit from our portfolio protection overlay. Now, part of our investment philosophy is that we respond to changes in financial markets rather than trying to predict them. So, after markets bottomed in March, we began to position the fund for the new environment. We reduced the size of the portfolio protection overlay to allow gains in stock markets to flow directly to our bottom line. We also reduced our exposure to international shares and foreign currency as the Aussie dollar rebounded. We allocated the proceeds to cash to provide the fund with liquidity for the impending early release scheme. Now, touch on our external fund managers. For Australian equities, we appointed 2 new fund managers and retired 1. In international developed market equities, we replaced our existing fund manager with a low-cost, tax-efficient manager who should deliver higher returns over time. We also increased the size of our commitment to a fund manager in the private equity space. This will allow them to invest more in private companies in specific growth markets. Now, I want to touch on our environmental, social, and governance activities over the last 12 months, as I know it's quite a popular topic. We have published our ESG policy, climate change position statement, and stewardship statement on our website, and I encourage you to read through these important documents. During the financial year, we made several changes to the stewardship of the fund. We reviewed the risk of holding stranded assets. The outcome of this review was that we divested from thermal coal companies in both our Australian and international developed equity mandates. We also applied a carbon reduction overlay to our international developed market equity mandate. This means that roughly $1 billion of your retirement savings are generating 20% lower carbon emissions than the benchmark. As you may know, we are signatories to 3 important advocacy groups: the United Nations Principles for Responsible Investment, the Investors Group on Climate Change, and the Australian Council of Superannuation Investors, also known as ACSI. We're active participants in all 3 groups. Now, whilst we don't advertise our credentials as publicly as other funds do, we do work collaboratively with these groups and their individual members to advocate for companies to meet best practice standards and hold them accountable for objective failures. Sadly, one example is the destruction of Juukan Gorge by Rio Tinto. Through meetings organised by ACSI, we were able to voice our concerns directly to members of Rio Tinto's executive committee and the board itself. When we observed inertia over the months that followed, we, along with other asset owners and fund managers, wrote directly to the chairman to push for accountability at the executive level. Soon after, Rio Tinto admitted that they made a mistake publicly, and a number of executives stepped down. I wanted to share this example to show you, our members, how Media Super practices active ownership. Now, turning to the outlook for the next financial year, we see a generally positive macroeconomic picture. Quantitative easing programs have been revitalised and are unlikely to be withdrawn anytime soon. Central banks have relaxed their inflation targets, ready for inflation to overshoot in the medium term. This means that supportive policies that are currently in place will remain in place, even as economic activity rebounds. Monetary policy is incredibly supportive. Interest rates are at new all-time lows, and importantly, 10-year government bond yields are very low. This underpins the value of growth assets by increasing the net present value of their cash flows. It also pushes investors further up the risk curve, which means they are likely to allocate capital into more productive asset classes. Turning to economic activity, we can see that global growth momentum is strongly positive. Manufacturing activity in the world's 3 largest economies has increased back to levels last seen in the first half of 2019. And this was before the recent encouraging results of vaccine trials. Corporate earnings too are rebounding, and they are on track to reach pre-pandemic levels by late 2021. Credit spreads are back to historically low levels too. However, we are watching for signs of weakness, especially after fresh lockdowns were recently announced in the Northern Hemisphere. Whilst the recovery will be patchy, with a backdrop of extremely supportive monetary policy, a clear rebound in economic activity, and rising corporate profits, financial markets should push higher. All of this is good news for your retirement savings. Thank you, and back to you, Shauna.
Thanks, Michael. There's some good news in there. It hasn't been a complete year of gloom, which is great to hear. That concludes the formal part of the evening. We'll now move into the questions and answers sections. We've had a lot of questions come through, so thank you to everyone who submitted questions when they registered, and also to those of you who have asked questions online just this evening during the meeting. Just a reminder that any questions that relate to your account or specifically to your circumstance cannot be answered in this format. If we don't get to your question because of time constraints, we will have a response to your questions available on the website in the next few weeks. So let's get started. The first question tonight comes from Ross. And actually, Ross is covering a subject about which we have received numerous questions. And this is about the future of the fund and the status update on current merger discussions. To answer these questions, I'll hand over to the chair, Susan Heaney. And Ross has asked us, Susan, where are merger discussions currently at with CBUS? What is the proposed structure in the merged entity? And for example, will assets be merged? Will there be a media super, or will it just be a work category within CBUS?
Great. Thank you, Shauna. And thank you, Ross, for your questions, because as Shauna alluded, I'm sure that that's on a lot of members' minds at the moment. And I'd also like to thank you for joining us tonight, because it's very strange sitting here looking at a screen, not seeing you members, but knowing that you're there and participating. So thank you. Before I start, I'd like to say that as a trustee board, our members are at the forefront of our mind in every action we take. And part of our process on an annual basis is to look at strategy, and that we have been doing over many years since I've been on the board. Gerard alluded earlier to the fact that the cost of running a super board or any financial institution these days is increasing exponentially because of technical reasons, because of administration and governance. And when looking at that, the pressure on our fund was becoming more and more prevalent. I'm not quite sure if Gerard mentioned, but to run a fund of our size, whilst we are a smaller fund, it costs as much administratively to do those governance processes as it does, say, a larger fund who may have 200 billion under investment. So as you can see, we have to consider that when we're looking at the outcomes for our members, and that's been at the forefront of our discussions moving into this process of doing pre-diligence to consider a merger. When we did the pre-diligence part of it, what we were looking for were partners we could align with, who had the same beliefs and cultural beliefs, had their members at heart and their outcomes at heart. So that's where we started the discussion. And with that has now brought us to the stage where we're in actually a full due diligence process. This process has been going on now for some months, and it's a very long and arduous process. And it's one that we hope will get us to a point where after independent assessment, we can confirm whether a joint arrangement going forward is in the best interests of both parties and that of our members. The joint arrangements would allow us to access scale, which of course is what I was talking of earlier, and it would be a benefit to the members. And with that in mind, we are looking to merge both the fund's investment and administration operations of CBUS and media together, if it were to happen, and have a focus on branding, because our branding of Media Super we're very proud of. We've got great relationships strategically with the industries we represent and the members that belong to those industries, and we want to continue that going forward. So that is also at the forefront of our mind. Obviously, we can't go greatly into anything past this stage, because at the moment the due diligence progress is still in progress, and until that goes further, we can't make any more announcements. But you can be sure that once those things progress further, you, the member, will be the first to know, and we will be making joint, if that's the case, announcements along with our partner in the future if we have one. So please be assured that we're taking our time, we're doing the due diligence, and we're always looking at you, the member, and the best interests that we can go forward with, and looking after you and making sure that you have your branding and you have a conduit, as you have now, to the fund and its trustees. Thank you, and I hope I've answered your question. Thanks, Shauna.
Thanks, Susan. Another common thread of questions we're receiving is in relation to how COVID-19 has impacted Media Super members. And will we see an improvement in 2021? What damage has the early release scheme done to the fund? Thank you, Maya. I hope I've pronounced that correctly. Thank you, Maya and Stephen, for your questions. And to answer these questions, I'll hand over to the CEO, Tony Griffin.
Thanks, Shauna, for that question. And thanks, Maya and Stephen. They're very good questions in relation to the early release program and what its impact has been. If we can just go back to talk a little bit about the process of early release. And the idea of the early release, of course, was to support members through allowing them early access to their superannuation. Normally, you wouldn't get access to your superannuation until you get to a point in time where you've hit a qualifying age, and that's really retirement. So this was an initiative by the government to open up access to a member's superannuation to assist them with getting through the crisis. So there's two tranches to the process so far. So the first tranche ended on 30th of June 2020, whereby you could take $10,000 up to a maximum of $10,000 out. And I said in my speech, on average, people were taking $8,600 out of their account. And you couldn't take two lots of $10,000 out in that period up to 30th of June. Then moving into the current period up to 31 December, members could access a second lot amount of 10,000 or up to 10,000, but couldn't go back and back claim on the first tranche either. So they were just the rules of the scheme. You had to go through the tax office to make an application, answer certain questions, and then your approved claim, if it was approved by the tax office, got sent to a super fund like us. Or if you were a member of another fund, you may have taken some money from another fund as well. So, but not exceeding the 10,000, of course. So that's a bit about the process in terms of that. There was quite a few people that claimed on that process. In the first tranche, $71 million was taken out of the fund, and to date in the second tranche, about another $69 million. We've seen in recent times that plateau out. There's smaller amounts now coming out. These amounts come out virtually on a daily basis, and we monitor them on a weekly basis, and we have to report them to our regulator app. And in terms of the damage this has done to the fund, there is no damage to the fund. Essentially, the fund is designed so that it collects money and pays it out. That's how the system operates. This rule has allowed us to pay these amounts out to members early, as I said. So there's actually no damage to the fund, except the funds under management has dropped. So it's plenty of liquidity to pay out those claims. In terms of members' accounts, though, this is a bit of a different story, because when Jared was talking before, he was talking about what I call the magic of compounding. And the magic of compounding is you start off with a smaller nest egg, it then starts earning a return, and it continues to grow, and it gets to a certain point of time where that momentum starts to increase, because the principal amount, the underlying amount of your account, keeps getting larger and larger. And there's no such thing as a quick buck, as they say. This takes time to occur, so you have to be very patient with the process. So if you're going to take an amount out at a particular age, whenever that be, obviously if it gets taken out when you're younger, the longer term impact of that is more than likely going to be greater. There's obviously a lot of circumstances to this, because investment return and risk makes a difference, and also depending on whether you've got an appetite to put more money back into your account as well to try and compensate. So there's all sorts of different ways that can be remedied, and I'd suggest you go and see a planner if you're concerned about the money you may have had to take during that period of time in order to get yourselves through COVID-19. But will it improve next year? Well, yeah, the scheme may get extended, and that's up to the government really at the end of the day. They may choose to extend it. Investment markets have already improved, so that started to add value back to members' accounts since that particular point in time. And members are also starting to return to work in some parts of the industry as well. So I appreciate there's still members who aren't, but members are starting to return to work. So yep, so we're seeing a stabilisation of the process in terms of the withdrawals, and it's not going to mean that the fund's life is going to end because this money is going out the door. Thanks, Shauna.
Thank you, Tony. I think that was a comprehensive answer. Keeping in the theme of COVID-19, we have received a question from Karen. What proportion of Media Super's future infrastructure And I'm going to direct this to Michael, our Chief Investment Officer. What proportion of Media Super's future infrastructure investment will be in Australia's digital infrastructure, given the huge need to keep improving digital access in the COVID and post-COVID environment? Michael?
Thanks, Shauna. Hi, Karen. Thank you for your question and your interest in our investment portfolio. Now, Media Super does not have specific targets for investing in different sectors or industries within the infrastructure asset class. Instead, the way we manage our exposure is that we try and hire the best managers in that asset class and use their expertise and experience to decide on which industries and sectors to invest your savings in. So what these managers will do is that they'll actively consider investing in specific new assets, such as digital assets, and participate in corporate deals in conjunction with managing the existing portfolio of assets on our behalf. Specifically regarding digital infrastructure, and for the benefit of other members, we're talking about things like data centers, fiber optic cables, both inter and intracity, cell towers, and assets like that. They're actually maturing into infrastructure-like asset classes, and they'll definitely be on our managers' radar as of today, especially with one of the current cell tower auctions that's going on in Australia. The extent to which our managers do participate in these asset classes will really depend on current prevailing valuations for those assets that do come to market and the market conditions themselves. I hope that answers your question.
Thank you. And now we have a question from Graham. How will the board ensure ongoing investment in the Media Super Film and Television Financing Fund as a part of the joint venture arrangement with CBUS? And we did hear a little bit about that fund in a couple of the presentations today. So I'm going to hand over now to our former chair, Gerard Noonan, to speak about carrying the investment forward in the Media Super Film and Television Financing Fund.
Thanks, Shauna, and thanks, Graham. Look, in our due diligence discussions with CBUS, there's obviously been considerable discussion about a whole range of things, including several investments. And so, of course, the film fund, of which we're, I think, rightly proud, has been an upfront issue for obvious reasons. It's part of our industry. It's a signature for us. We're really the only serious player in this area of the producer offset, and there's been a significant amount of money presented to the industry in that method, and we've made a significant return for our members as a result of it. So it has been an upfront issue in the due diligence discussions, and we've indicated to CBUS that this is quite important to us for obvious reasons. And look, I know I made mention of Last Cab to Darwin a little bit earlier, which of course had the actor Michael Caton as the lead actor in that, or one of the lead actors. And those of you with a long enough memory would probably recall a film that Michael Caton starred in a long time ago called The Castle, or Castle if you live north of the Murray River. And all I could say to pick up Michael Caton's kind of tone is the vibe is looking pretty good. But again, this is a matter for due diligence, and so that it's part of the total package. But it's important to us. We've definitely put it on the table, and as I say, the vibe is the vibe.
Thank you, Gerard. And as was highlighted before, it's been a great investment for our members. So I think it can certainly be justified on the basis of its returns and risk profile for our members. We are receiving a lot of members' questions in relation to Media Super's investment or focus on fossil fuels and ethical investments. So I'm going to hand over to Michael McQueen in a moment, but we have a question from Louise about what are we doing to make sure we're not investing in fossil fuels, particularly because they may be stranded assets. We have one from Jeremy. Jeremy says that he understands that we've partially reduced our investments in fossil-related organisations. When will this process be complete? We have one from Victor, who asks, to what extent is Media Super invested in fossil fuels, such as companies like ExxonMobil and Chevron Corporation? And what is our attitude to fossil fuel investments? We have one from Greg, who asks, in round figures, what percentage of our total funds is invested in fossil fuel enterprises? And do we have a policy of divestment from such enterprises, and in what time frame? Alex has asked us, what has Media Super done to move towards investing in a sustainable future and divesting from industries that would prevent us from making those shifts? Shane asks how much focus the fund is putting on ethical investments. Shannon asks how Media Super is moving towards more sustainable and ethical investments. Greg has asked, in round figures, what percentage of our total funds is invested in fossil fuel? So that's just a number of questions we've received on a similar theme about ethical and responsible investment. And I know that Michael is very keen to answer this question. So thank you, Michael.
Thank you, Shauna. I hope you don't expect me to answer each and every one of those questions. But thank you, everyone. Hopefully I've covered off on some of your questions and let's be honest, some of your concerns in my presentation. And again, I'd just like to reiterate that it's been a great year for the fund stewardship, as hopefully I outlined previously. I'm very pleased to say that our current process is complete, and I do stress that that's our current process. And I'm talking about our divestment from thermal coal companies in Australian and international developed market equity mandates. We completed that before 30 June. Again, that's $2.5 billion of your retirement savings that are not exposed to thermal coal companies, and they're inherently higher risk of owning stranded assets in the medium to long term. So we've already done that work on stranded assets, which led to our divestment from thermal coal. Now, of course, if market conditions change, we will revisit and update our position on other fossil fuel assets. And going forward, and this is really important, we will continue to engage with fossil fuel companies on that we do own on how they best minimise their stranded asset risk. One example I can share with you today is that we're currently in discussions in one of our existing private equity investments, a company that owns fossil fuel assets in North America, about how they improve the casing and plugging of idled and abandoned wells in North America. And the reason why I raise that is that our engagement there will lead to less methane leaking into the atmosphere and lower remediation costs into the future, which will in turn lower that company's cost of equity and debt and increase their access to those funding mechanisms. I'd also like to make the point respectfully that we can't simply divest from companies that we don't like. An analogy I like to use is that if you assume, in this case, Media Super is the last environmentally aware investor or owner of a fossil fuel company, and we sell our shares, then that entire registry is held by a mixture of retail, wholesale, and institutional shareholders and owners who are inherently not concerned with environmental impacts and will not hold executives' feet to the fire. So there's a lot of work to do. We need to stay invested in some of these companies and push for change to manage their environmental impact and minimise the risk of them owning stranded assets in the future.
Thank you, Michael. That was a comprehensive reply. I'm wondering, can you just explain for some of our 200 plus members who are on tonight, what is a stranded asset? What do you mean when you say a stranded asset? And what impact does that have, on our fund in terms of its performance and the impacts on members?
Sure thing. So in very broad general terms, a stranded asset is an asset that you can't move, you can't sell. Maybe a good analogy, again, not wanting to cast aspersions, but a good analogy was what happened in March and April of this year on the stock market, on the Australian stock market. A number of travel companies went from being worth, $10, $15, $20 a share down to, $3, $5 a share. They completely plummeted. Because they were unable to be sold to anyone because everyone knew there was a huge risk profile associated with those investments. So when we look at stranded assets, we're talking about sort of assets in situ, things like oil wells and mines. And the issue there is both technology advancement as well as changes in environmental policy for the customers of those mines, which means that literally the earth that's being dug out of the ground won't be able to be sold. and the price will decrease of those commodities. And then, you know, who do you then go and sell that mine to? And the other, I don't know, apologies for getting technical, but you bring forward a non-current liability, which is site cleanup costs, into sort of the present or into the very near term. And quite often that is not efficiently priced by the market as well. So there's sort of multiple issues there in terms of stranded assets. And whilst we can, you know, probably all of us can see a future where we're a lot less dependent on petrochemicals in the short term, that's a lot less likely than the transition away from thermal coal.
That's great. Thank you for that extra explanation, Michael. Sometimes in investment land, we need to remember that not everyone understands what these things are. So thank you for that. I appreciate it. I have a question here from Stephen, and I'm going to pass this one to our chair, Susan. If the government scraps the 12% contribution target for super accounts from employers, what will the impact be overall?
Thanks, Shauna, and thanks, Stephen. Obviously, this question can have different answers depending on where you're sitting in the situation. So I'll try and answer it as probably interests of members, because that's what we're here representing. We're all believers in the superannuation model. That's why we sit here. We all agreed that superannuation needs to increase so we can better refund the retirement outcomes of all Australians. I think we heard from Tony earlier saying that we're on our way to getting the members of Media Super onto that journey, but we still have a way to go. I think the percentage Tony quoted was about 62%. So we're still some way from making sure that our members can retire with better benefits and live comfortably. So obviously, if we don't increase, if the government decides not to increase the contribution target, it will affect members down the track. It will be detrimental to their savings outcomes when they retire. We're an ageing population in Australia. We all recognise that, and it's been on the political spectrum for some time. With an ageing population, you already have pressure in the future on funding pensions because there'll be less taxpayers. It could mean that you've got people who are working now working for longer, which also then puts more pressures on younger job keepers trying to come into the market because there's only a certain amount of jobs. And if people are staying there longer, we're not opening up another market. So it's obviously a very complicated question. And I'm trying not to simplify it too much. But from our point of view, members' retirements are our number one, and we need to advocate to try and make sure that we can get their best outcomes. And that's what we are trying to do. So the overall impact, I would say, would be detrimental for those members who are still struggling to get to a good point at the moment. And that would be the same in our fund as it would be across a lot of other industry funds out there. Thank you.
Thanks for that, Susan. Michael, I might return to you for a moment. I have a supplementary question, as it were. Michael, you've talked, we talk a lot about environmental, as we call it, using those overlays on our investments. And you've certainly addressed the environmental ones that are at the forefront regarding fossil fuels and divestment. Can you tell us a little bit about social and governance, and particularly maybe on the social, on the S of the ESG, a little bit about the Modern Slavery Act, which is something that has only come to us probably in the last financial year, in the financial year we're talking about?
Sure thing. So I might go back to the beginning for the S in ESG, as we call it in the office. What that originally meant was social factors, and really that was injuries in the workplace. And there's actually a good history there. It's called lost time frequency injury rate, I believe. And that's been published by listed companies for decades. And it's been sort of the one metric we've had there to look at the S in ESG. Pleasingly, that's changing, and it's changing very rapidly. So that's going from injuries on the workplace through to very sort of modern and big global issues like wage bonding and modern slavery. So that's something that the industry is becoming very aware of, and we're pushing for companies to monitor their supply chains for instances of terrible things like child labour and wage bonding and very, very unethical labour practices. So that's one way it's changing. Another thing that members will hear a lot more about in the future is modern slavery. We've obviously got the Modern Slavery Act here, designed to prevent modern slavery and reduced instances of it occurring in Australia, modelled off the system in the UK. So what that means is that Act does extend to Media Super as well as every other super fund. So we're currently going through a process of checking our investments and checking our suppliers of the trustee company for instances of wage bonding and other poor practices that would fall under the Modern Slavery Act. So it is a developing field. It is one of the newer fields in ESG, environmental, social and governance research, but it's one that's typically been potentially neglected over the last 5 or 10 years. So it's great to see that that's getting its moment in the sun and that's maturing.
Thanks, Michael. That's great. We might give you a little break now. I have a question for Tony. Given the shocks to the media, entertainment and art sectors these past few years, and the large number of redundancies and unemployment that has followed, is this affecting the integrity or liquidity of Media Super's investments? He also adds, I imagine there are many more members drawing pension streams and fewer contributing to their accounts. So how does this impact costs and the long-term viability of Media Super overall?
Thanks, Shauna. And thanks, Xavier. Some a lot of good questions here from our members tonight. So thank you for these. Yeah, just in terms of, let's talk a little bit about how this whole process of super works. And it's a machine. It's a big machine. It's a mandated system. There's mandated contributions, and we're talking about 9.5% at the moment is the current rate of employer-related contributions that are mandatory on people's salaries who are employed. And you've got the contributions, you've got the roll-ins. So roll-ins are transactions where members are moving from one fund to another. It could be a peer industry fund, it could be a retail fund, it could be a bank-related fund. So money is rolling through this universe, if you like, constantly. And then we have withdrawals coming out as well. So withdrawals, some members taking lump sums. They're getting to retirement, they want to take a lump sum. They don't want to necessarily take a pension. So they take a lump sum. They buy the RV. They do all sorts of different things. So they take a lump sum. So pensioners themselves, pensioners probably represent about 3% of our members. So around 2,500 pensioners we've got in the fund. You might be surprised about that. It doesn't seem a lot, does it, at the end of the day? But we've got to remember that this system was introduced in 1992. So it's taking a while to mature. Yes, we have an ageing population, but we actually haven't had a huge amount of withdrawals from the system so far because so much has been inputted into it. And this is why you hear a lot of dialogue going around town about, money's now starting to come out and, is this a problem? Do funds have liquidity to be able to cope with this? And they do at the end of the day. We have some very strict rules around liquidity. And how do we control that? A lot of our investments are in listed type vehicles. So whether that be listed shares, whether that be bonds, whether it be listed trusts, unit trusts. So these types of investments, which make up the lion's share of our $5.9 billion, money can be sought after very quickly if needed. So this 140 odd million that we've had taken out through early release, we had plenty of cash to be able to fund that. So we didn't even have to sell down a lot of investments to be able to fund that. So we still were within our liquidity limits before we had to sell down. So this is how the process works. There is a lot of rules, as I said, around liquidity. We have regular meeting with our chairs where we review the liquidity position of the fund to make sure that it's working within its liquidity limits. And so in terms of will this have any detrimental impact on cost and the future viability of the fund? Well, costs are driven by a multitude of different reasons. So one of our primary areas of controlling costs, and we sort of talked about costs during my speech, being costs were actually down on the previous financial year. What is a bit of a threat to costs at the moment is there's been a lot of prudential change that the government's been asking us to implement, and a lot of that prudential change is very good prudential change. It's tightening the system. It's making the system much more robust, so that members have confidence in their money sitting with a super fund like Media Super, that it's safe and it's being well protected by us, and we're acting in your best interests 24/7. So, and that's the idea of these prudential changes. It does come with a cost. It is increasing cost because we've got to maintain all the controls and the processes related with implementing that prudential change. So, but as I said, we've been containing costs. And so moving forward, as we talked about, we are looking at a merger partner with a larger like-minded fund. We're doing that for a very good reason, and that is to be able to benefit from the scale of the investments of that of those big funds, one of those big funds, and we talked about CBUS in this circumstance with $54 billion worth of funds. When you're that size, you can get access to a lot more in terms of investment management, and the cost of investment management drops quite substantially when you get investments of that size. So the other thing, you can deliver a different level of service as well. So given we're talking about, we've got just over 2% of nearly 3% of pensioners, obviously that number's going to pick up over time. And it's not that we can't pay the money out to the pensioners, it's that in that journey to get to pension phase, we want to be able to improve service. We want to improve services around advice, and we want, and particularly around advice, and different cohorts of members have different requirements around advice. Some members don't want to talk to a planner. They may want to go through and do some digital type advice, or there's intra-fund advice as well, where can be done over the phone, or there is the full comprehensive advice sitting with a planner as well. So we want to be able to develop those sorts of areas to provide better services to members moving forward, and working with a larger fund facilitates that ability. So I hope that answers your question, Xavier. It's not the current environment that's necessarily putting a lot of pressure on the fund in terms of its costs and in terms of its long-term sustainability. It's more the government actually has said to the industry, that the industry funds in particular, that they would like to see them consolidating moving forward. And as I mentioned, the way we achieve those synergies and get those benefits, and that's what we have to do. If we can see those benefits there that are available to you, we have to go and seek and try to make sure that in some way we can pass them on to you. So thanks, Shauna.
That's great, Tony. That's really comprehensive. And I'm afraid, Michael, you're back in the hot seat again, because investments are what it's all about, really. I have a couple of questions here from Simon. I think we need to deal with them separately. Do you have defensive assets like gold, silver, and cryptocurrency in your portfolio? And when he says your portfolio, I think he means our portfolio as members. So we can use our funds to be managed by that when the stock market crashes soon. So there's a couple of assumptions in there from Simon that the stock market crash is coming. In fact, his second question is the stock market crash is imminent and looming, coming into 2021 and 2022. How do we protect our super assets and investments leading up to it? So I've given you that as a bit of a cool. I'm happy if you want to deal with them separately, or you might want to do them together.
Thanks, Sean. I'll deal with them separately first. So, hi, Simon. Great question regarding gold and silver and crypto. It's very topical for some of our members, especially our younger members. We have not directly invested in physical commodities like gold or silver. As you probably know, commodity prices are quite volatile, and commodities themselves do not pay yield or an income stream. In fact, it goes the other way around. You've got to pay to hold physical commodities. So it's a headwind to returns apart from the capital component of how the price moves. And specifically on gold, look, gold can sometimes be a good hedge against the volatility that we see in share markets, but at other times it can be an ineffective hedge. So that hedging quality to gold sadly isn't persistent enough to justify an investment into that asset class for us. Regarding cryptocurrencies, again, we haven't invested at this stage. Yeah, I said before, commodity prices are quite volatile. Cryptocurrency prices, again, as you probably know, are very, very volatile and thought to be subject to widespread price manipulation. So like commodities, crypto doesn't pay yield or an income stream either. So we don't get a passive return from owning that asset. And look, in all honesty, if crypto does mature into an institutional grade asset class in the future, we'll reassess our stance. And if you wound the clock back to the 70s or the 80s, probably would have been saying the same thing about junk bonds, which is now called high yield bonds. And potentially it would have had a similar discussion in the 80s or 90s about private equity, about this new asset class. So things can change, but at this point in time, look, we do prefer traditional defensive asset classes like cash fixed interest, which have a strong lack of correlation to growth assets. And this lack of correlation is very, very persistent, regardless of what market regime we're in. So that's how we tackle the defensive sleeve of our portfolio. Look, in regards to your second question, I suppose I've got a different view than you. I think we just had the crash. So we're not really positioned for another crash. We do obviously have levers that we can pull. We can change our investment strategy. We can change the strategies that we ask our managers to employ on our behalf. And we've got a portfolio protection overlay too that we can use. So we do have quite a number of defensive elements or tools in our arsenal, but right now we don't see a crash. And remember, what I said in my presentation, we're trying not to predict markets. We're trying to react to markets, because the danger is that you, ipso facto me, may have a very good thesis for why there's going to be a crash in financial markets. Might have a gold-plated thesis, but the issue is that we can be wrong for 1 year, 3 years, 5 years. That crash may not come for a long time. Members will retire. They'll retire with suboptimal account balances, with lower savings than they would have had otherwise. And the issue is that as we've seen for decades, and it's the beauty of compounding, the market can keep going up. So if you're wrong, you could be wrong for quite a long time.
I'm conscious that we are very close to time. Thank you for all the questions that have been submitted tonight. And questions that you have asked that we haven't been able to answer will appear on the website later. I think I might just squeeze one more in for Michael, because I don't think he's done enough talking tonight. So Michael, I have a question here from Philip, and Philip asks, what effect, if any, did put options have on the returns for the 2019-20 for the balanced fund?
Thanks, Shauna. Hi, Philip. Great technical question there. So you're spot on. We use put option spreads to construct the portfolio protection overlay for the balanced option that I spoke to just before. And apologies if I call it insurance. That's just sort of colloquially how I think about it. It's not an insurance policy. It's just a term we throw around the office. So let's just make that abundantly clear. So in March, as I said in my sort of main presentation, we monetized $25 million in put options when volatility spiked. So the value of those put spreads went up, or the long leg did. This actually added at the time about 0.5% to the balanced options return. So it was a very good trade and helped to buffer some of the losses we experienced in other assets, unrealized losses in other assets at that point in time. As you probably know, volatility has remained elevated post-March into 30 June. So we actually didn't buy additional options due to the higher cost, and also the fact that the payoff just was nowhere near as high as it usually is when we purchase these put spreads. So we resisted the urge. We do regularly check the price of volatility and the inherent risk reward trade with these options as a first step before we look at how the balanced option is positioned with regards to its risk profile and its exposure to growth assets. So it's not sort of a hard and fast rule that we that we acquire these put spreads blindly. We will be price driven and we'll also be conscious of the overarching market dynamics.
Thanks, Michael. They have been an important part of our investment strategy over recent years. So thank you for telling us a little bit more about that. And I'm afraid it is time to draw our meeting to a close. So once again, thank you for joining us this evening. Thank you to the board, executive and other staff who have made themselves available for tonight's annual member meeting. A reminder that the minutes of tonight's event, along with responses to any of the questions we couldn't get to, will be online in the next few weeks. In a year that has thrown everything at us, we hope you found comfort in the results and dedication of the team at Media Super. And I hope you were pleased to meet some of us tonight and learn a little bit more about what we do. If you have any questions specifically about your account or the information presented tonight, please email the team at communications@mediasuper.com.au and they will be able to help you out. Have a safe and enjoyable festive season, and I wish you all good night.